to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up, don't miss an amazing interview with Michael Oliver of Momentum Structural Analysis. Michael has decades of experience in the financial industry and has been all over this silver rally since the most recent surge began back in the fall, and is someone we follow very closely here at Money Metals. Oliver has some very exciting things to say about gold and silver and why his analysis is telling him this is going to look different than the past bull markets of 1979 and 2010, and makes a very strong case for some extraordinary price targets for the metals, numbers that may cause you to be taken aback. So be sure to stick around for Mike Maharrey's conversation with Michael Oliver, a man who has absolutely nailed just about everything we've seen with the recent explosive move in silver, in an interview I can promise you do not want to miss. And if you enjoyed this material, please do us a favor and like and subscribe to this podcast wherever you consume this content. Silver continues its stunning rally, zooming above $90 this week on inventory tightness globally. Meanwhile, gold surpassed its all-time high from late December earlier this week and is currently trading right around $4,600. As of this Friday midday recording, gold checks in specifically at $4,592, good for a weekly gain of 1.5%, but is off its highs of over $4,600 earlier in the week. Turning to silver, it's been another banner week for the white metal, which, while off its highs, is still checking in with a 10.4% gain and a price now of $89.45. Platinum is up 1.7% to come in at $2,323. And finally, palladium is off 1.7% to trade at $1,808. Money Metals is seeing another new influx of first-time purchasers, Americans who have realized how badly served they've been by their financial advisors, who never once recommended gold or silver exposure. Virtually all products, amazingly, remain in stock at Money Metals, but many competitors are facing serious inventory challenges due to extremely high retail demand across the U.S. market. Imagine if the percentage of Americans buying physical gold or silver went from about the 1% level that it is now to 2%. That's a 100% increase, a staggering amount of volume for dealers and mints to handle. Next, imagine if retail participation went from 2% to 4%. Make no mistake, if the public tries to get involved in a meaningful way, there is absolutely no way such demand could be accommodated anytime soon. Meanwhile, there's a current rumor circulating in the precious metals industry that the U.S. Mint is plumb out of silver. The key evidence used to substantiate this claim is at the U.S. Mint website, which has, indeed, stopped selling certain collectible silver items. Since the price of silver has increased by nearly 200% in the past year, these extremely bullish days have put a lot of pressure on the whole industry, and that includes government quote-unquote enterprises in the space. When spot prices continue to rise, those respective websites must update their pricing constantly so they do not sell at a loss, particularly bullion-focused sellers like Money Metals. And with the sharp rise in the price of silver, nearly doubling in 4 months, the fixed prices of the U.S. Mint's high-premium burnished and proof coins were suddenly no longer twice the silver spot price like they normally are, but were priced at or below current spot. The U.S. Mint does not sell the bullion American Eagle coins directly to the public, but what the public can purchase on the U.S. Mint's website is all the kind of stuff that is not really a silver investment, but a spiffy supposed collectible item. The simple fact is that the flat-footed government officials and bureaucrats in Washington, D.C. are incapable of gracefully adjusting to market fluctuations. Government inherently involves bureaucratic meetings with senior officials and possibly internal votes or rule changes to react to pretty much anything. In order for the Mint to adjust to the growing demand in retail physical silver products and to continue profiteering off the public with their high-margin collectibles, government managers needed to put a pause on silver sales until they can determine new product pricing that may last for a while, such as through fiscal 2026. Therefore, a key takeaway about the Mint's decision to stop selling its marketable items is really this: governments are bad at business. An actual business would simply adjust its pricing on the fly. Conspiracy theories, hearsay, and precious metals dealer hype may have contributed to a misunderstanding that there is little to no silver available in the market. What's happening with silver is certainly momentous, and the outlook remains bullish, but it's wise to try to tune out the over-sensationalized hype the best you can. There's no need to buy silver coins from a government source that, more often than not, overcharges for their products anyway. A similarly juicy rumor is currently making the rounds regarding China's limitations on silver exports, but this too has turned out to be overstated, as our analyst Mike Meharry explained this week on our website. Money Metals has plenty of silver in stock right now. The only issues we have are delays in order processing due to the overwhelming volume of retail purchasers and sellers that are choosing to do business with Money Metals. We've already hired 45 new employees and counting since just before Christmas to help address the high order flow and phone call volume. If an item on the Money Metals site actually goes out of stock, customers can sign up for an email alert when it's back. And no, Money Metals does not have a shortage of American Silver Eagles right now, but the better value will always be silver bars and rounds, so please take a look at moneymetals.com. Well, now, for more on the recent action in metals prices and where they might be headed from here, let's get right to our exclusive interview.
Greetings, I'm Mike Meharry, and I'm joined today by Michael Oliver. Michael has been in the financial services sector since like the mid-1970s, and he's developed a very unique technical approach to market analysis that we're going to get into. He's been pounding the pulpit for silver, and I'm really excited that we're able to get him on the show today. How are you doing today, Michael?
Great, Michael. Good to be here.
Well, I've been watching some of your videos and some of the stuff that you've talked about with silver, so I'm really eager to get into the nuts and bolts of the silver market here. But before we do that, I would like for you, since this is the first time you've been on this particular show, I'd love for you just to give a little background and let folks know who you are and kind of where you're coming from.
Well, I started after being a futures broker since April 75, a few months after gold was legalized. I worked for E.F. Hutton in New York, their headquarter commodity division. I was a novice. I didn't know technical analysis from anything. But my boss, who was head of the Hutton's commodity division, was also chairman of the COMEX at that time, up through 1980, in fact. And I learned raw, bar chart type of technical analysis. But I evolved in the early 80s into using my own method of momentum analysis, not the stuff on your screen like RSI or MACD, but I take price and I convert it to momentum bar chart of price. Where is it in relation to a given average? And I oscillate it. Okay, create an oscillator. Okay, wow. And it has technical structures just like price charts. Uptrends, floors, ceilings, the whole thing. The only difference is almost always before a major turn occurs in the market, its momentum will have broken first, will have given the signal. So it's a good early warning system, and it's helped us a lot. So I started MSA, Momentum Structural Analysis, in 1992, mainly with institutional clients. In 2015, I opened it up to retail subscribers. And we focus on all the major asset categories, but of late, especially the monetary metals, because we have argued over the last year, 2 years, in fact, that the upside is in this bull trend in the monetary metals is not going to be a normal bull market. So any dimensionalities or overbought levels you think are applicable, forget them. Not going to be true.
Yeah. So when you're looking at momentum structural analysis, can you kind of let folks kind of explain the difference between that and the more traditional price analysis? What are you able to gain?
Once you plot, everybody overlays moving averages. You see a price chart with like a 200-day or something like that. Well, you could take the 200-day even, and you could plot where's today's high, low, close in relation to that average. It's a certain percent above it, a certain percent below it, or where. So you plot the bar not at the price level, but at the relative to that number. How much above? It's the high, low, and close. And you create an oscillator over time that gives you a different visual picture than when you look at a price chart. Quite often they're in sync. They agree with each other, but usually at turn points, they deviate. And momentum starts to tap you on the shoulder like, this isn't what it looks like, And anyway, this time around in gold and silver, and we're flexible. I mean, in gold, for example, in 2011, December, a couple months after the high of that bull market peak that hit 1920, we started to turn bearish and turn full bearish in January 12th, much to the complaint of many subscribers. And it hovered around for a year and then crashed all the way down to 1,050. No, excuse me, 1,500 in 2015. No, I'm sorry, it was 1,050, whatever. Anyway, and we've been in a bull market since. Now, it's 11 years old, so it's quite old, but it is not even the same dynamics as the prior two bull markets. Think about this for a minute. When you look at a price chart of gold, you say, oh, golly, I got to take profits, right? Okay. If you go back and look at the 1976 corrective low near 100 to the peak in 850 in 1980, that's an 8-fold gain in price. Bear low, bull high. 8-fold, 8 times. Same thing, 2001 to 2011, 8-fold gain in price. Bull market took 10 years, different time span, same dimension. Well, our bear market, started where? 1,050. We're only 4-fold, okay? You get the point? So a lot of people who think this is overdone, we're only half the dimensionality of the multiple gains seen twice before. So if gold even just matches the prior bull market peaks in terms of, how much did it go up on a percentage basis? We got to go to 8,500, okay? And that's only to say, I did it twice before. We're in far different conditions than we were then in terms of the fundamental, macro, technical, and fundamentals. I don't think it's going to stop there, but I think, just as a reference point, think about that. Another 8-fold move, big deal, 8,000, okay? And yet people are all eager to take profits. I don't think they appreciate what's going on this time.
Yeah,
it's not
absolutely.
the same. Yeah. And silver is a dog. It's been a dog for so long, it's now catching up. And it's going to catch up in such a horrifically fast and dimensional way that people are just going to sit back and say, golly. Anyway, go ahead.
Yeah, it's interesting watching people respond, particularly to the silver market. Today, I think we were over $90 this morning. I think we still are. And, it's amazing because it seems like yesterday we were talking about, we're at $50, right? So a lot of people look at this and they say, it's moved up so fast. It's got to be a bubble. I've got a lot of people, I get emails every day. Hey, Mike, should I take my profits?
Okay.
What would you say to those folks?
Okay, we've been arguing for about 6 months now that since middle of last year when silver was approaching 35 for the third time. It hit 35 in October 24. It hit $35 in March of 25. It got bagged. And on its approach back up to that high, we said, okay, silver bull market is now going to accelerate. This was based on momentum factors. Well, we went from 35 and in huge chunk layers we advanced. But something else happened in October, and this is not evident on price charts. When we measure the relationship between silver and gold, and the way we do it is this. We take an ounce of silver price and divide it into an ounce of gold and express the answer as a percent. Early this year, silver was down to 1% of the price of an ounce of gold early this year. It started to surge, particularly in April, May. Okay. It's now up, it's doubled in value, okay, relative to where it was then. But when you go back 50 years and look at where silver was during the bull market periods, that would be 1979 to 80 when we were approaching 50 in the box, that 50-year range of price. And then also 2010 and 11, silver was in a dynamic bull. It also went up to 50. At those two times, the spread value of silver versus gold was 6.5%, the price of gold, and in 2011, 3.1. Okay, I'm talking monthly peak closes. We came from 1% early this year. What do you think? It's going to zero? Okay, the point is the spread, when you plot that spread chart, connect the dot type thing. Where did it close this month? Put the thing on the, what percent? You plot it on a chart. There was a ceiling that goes back 10 years on that spread that we blew through in October and November. And since then, what's happened to the net price of silver? Boom. Not only has the spread gained, but its net price has gone vertical. The same type of behavior was signaled by that same spread action in summer of 1979, just before it almost quintupled in the next 5 months. And in September of 2010, when it doubled in a half in the next 6 months, price of silver did. So the spread breakout wasn't just relative to gold, it also indicated a power infusion into the silver market itself. And we're seeing that now. Both of those moves lasted a couple quarters. In other words, once you broke out, you surged dynamically for a couple quarters. Okay, we've now blown out the old archival $44 to $50, $4 to $50 range that persisted for a half century. While most markets were well above that comparable range, by the way, copper, even lead. Gold never stopped at the 1980 high in 2011. It went way above it. Silver did, okay? And silver only just recently went through that box. Silver is stating to us in long-term momentum and its relative valuation levels that it's going to an entirely new reality. And I'm going to suggest the following. In the next handful of months, expect to see silver in the couple hundreds and quite possible 300 to 500. And also see those old spread relationships between silver and gold, 6.5% of the price of gold, 3.1% of the price of gold, to be challenged and possibly even taken out. You do the math on that. If gold were to merely replicate its old eightfold move and go to a high this year, let's say of 8,000 or something. I think it'd go way past that, but let's just assume it does it again. Okay. Ho-hum. What's 3% of 8,000? What's 6.5% of 8,000? You'll fall over. Okay. Silver's going to a new reality, and it's going to do it so rapidly that those who are used to normal trends will miss it. Because they'll say, oh, it's overbought. I got to get out. They're going to miss the move. That's our assessment.
Yeah, and that's what I'm hearing from a lot of folks. I just literally 5 minutes before I got on.
And only lately, I suspect, too, you're hearing that.
Yeah. This guy was telling me he's convinced that silver's going back to 35 because he said that's where it is. And he doesn't see any reason that, given that the CPI has gone up, that the silver has gone up so much more. So he's kind of doing a CPI.
Golly. That's not good inflation metric, by the way.
Well, no, it's not at all.
M2 is a better one. Yeah. And if you look at an M2 chart, it's gone parabolic. Okay, why shouldn't the silver?
I'm glad you mentioned that. I've been hammering that point for about 3 months, and people don't want to listen to me. So,
well, it's fine. I like that because that means if you're right, you don't have the mob behind you until late in the move. That's when you want to see them show up, late in the move.
So you said, I've heard you say that copper and lead have shown similar dynamics in their breakouts in the past.
Long time ago.
Yeah. Can you
I'll give you one example. We did this not to just to show that it's not unusual. It's rare, I admit, to see what silver's going to do. Is a rare event for a market to go to a new reality. But copper, for example, was caught in a range from 50 cents to $1.50 for decades. Late 1970s, 80s, 90s, 2000, 2005, and late 2005, copper finally said, oh, I'm going to break out of the old reality, like a $1.50 highs, okay? Like a ceiling. Silver had it for 50 years at $50. Copper had a ceiling for many decades at $1.50. In literally several quarters, copper went to $4.50 on its own. It wasn't part of a gold move. It wasn't part of other base metals. It did it on its own. Then you look at lead, same sort of range-bound reality for many decades, boring as hell. And in 2007, a year and a half after copper did its thing, lead quadrupled plus in several quarters when it broke out of its old reality. In other words, it just destroyed any notion of overbought. It destroyed any notion of arithmetic swing measurements. And it went fourfold in several quarters, two to three quarters. and lived in a new reality after that. In other words, yeah, you had a sell-off after that, but it was like 4 times the average price of what had existed in the prior reality. Well, if you look at a silver arithmetic chart now, you see this $4 to 50, $4 to 50. So you see a $45 range. Okay, it suggests arithmetically, dollar to dollar, you're going to go up $45. The range was 45 thick, go up to 95. Let's approach 100. Okay, we're there now. Maybe some idiots want to sell it here. But if you do a logarithmic scale dimensionality, ratio scale move, when you go from $4 to 50, that's more than a tenfold move. You did it twice in 50 years. Well, tenfold past 50 is what? 500, okay?
Right.
Don't be stunned, okay? Anyway, that's the reality we're facing. And I think you're going to find all the excuses or headlines you want to assign to this later in the year after much of the event has already occurred. Political instability, Federal Reserve in total doubt. Who cares anyway? That we don't even need it. All kinds of fundamentals and assumptions that have prevailed for a very long human lifetime, like the Federal Reserve just over 100 years, are going to come into question. And people will say, hey, I want something real. My grandpa told me about this. I wish I'd kept his silver coins he gave me. You get the point? They want to feel grounded. And silver and gold are that. They are money. They are money.
It's interesting. I play hockey, and I'm on a team with a lot of really young guys in their mid-20s. And they seem to be more interested in precious metals than a lot of the folks that are closer to my age. And it's almost like they intuitively understand that their money is broken. And
yeah. No, look at M2 again, M2 chart, money supply. And it's just blowing off the page. I mean, you go decade to decade, it increases in quantity, supply, the M2 chart, by about 80% every quarter, every 10 years. Okay. Well, I mean, that means if, when your dad or granddad built a house, it cost him $4,500. When your dad built a house, it was $45,000. Right now, the mean price of a home is $450,000. What does that tell you? The degradation of the money unit. So if you bought a stock 10 years ago and it's doubled in price, you haven't made any money. You just kept even the decaying value of that piece of stuff in your wallet. Once that reality hits, and it's not just U.S., it's Japan, it's Europe, it's U.K., their debt markets are in jeopardy. The government debt markets, bond markets, 30-year UST bond looks like hell. If you look at a chart, it is comatose. They can't get it off the high yields. They can't get it off the price floor. The Fed even announced in November, the head of the New York Fed, Williams, said, we're going to start, quote, buying bonds. And his excuse for that was, just to provide some liquidity for the market. Bull. Right. They did it to provide support. Yeah. We have a crisis in government debt. This is not a mortgage crisis like 7 through 9. This is a U.S. government bond crisis. Japanese, UK, any one of which goes, the whole Western world goes. Okay. Yeah. Silver and gold know this. And if the central banks react to it by printing more money, what does that do for gold? Fuel in the tank. Yep.
My friend Greg Weldon, I don't know if you know Greg or not, but he's a pretty good analyst in his own right, and he's coined the term the debt black hole to kind of describe this situation. And it's not just government debt; it's corporate debt, it's individual personal debt, and I love that term because it kind of alludes to the fact that when you have all of this debt in the financial system, it warps everything just like a black hole. The gravity warps everything.
Well, the Fed's going to have to fight it. They know that. That's what they're paid for, okay? Especially to save government debt. Well, that takes a lot of money, babe. That money supply growth is going to accelerate. We'll look like the Weimar Republic here soon. Not just us, but Japan, Europe, UK, which I understand is in dire straits. It's a horrendous black hole that's spinning, and yet few people recognize it yet because primarily, like the UST bond market, is comatose dead, but it hasn't dropped in price, risen in yield through the recent ceiling on yields because they're trying to restrain it. But even with all their money, they can't seem to get it to go the other way. which says, oh God, if it starts to broke through those ceiling highs on yields or go through the price lows that we've recently seen. In fact, right now, T-bond futures, 30-year bonds, are 116. They had a crash low, effectively, in October of 2022 at 117. We haven't been able to get off the floor in 3 years. That's how sick we are. And if they go down to 111, it's flush city by our technical measurements. And they've been there before. You can't go there again. And you're going to have a crisis, an emergency type ambush in the U.S. government bond market, which so few people are paying attention to right now.
Yeah. You talk about a new reality, as specifically talking about the silver market. We're entering into a new reality. What do you think causes assets like silver, gold, whatever, to get mired in an old reality for so long?
I don't know. That's a good question. I mean, there are legitimate arguments and proof that silver's been manipulated.
Yeah.
Okay. Why hasn't it done what copper did 20 years ago or lead did 20 years ago? And, say, hey, I'm going to go to a new reality. It didn't take some great external prodding. They did it on their own. Or gold, who repeatedly take out the old highs by multiples. And yet silver stay in a box? What the hell's going on there?
Yeah.
Okay. Well, if in fact it's been manipulated, probed constantly by certain banks, possibly backed by, the central banks, whatever, they're fighting reality. And whenever you fight reality and start to lose, that market eats you up. It'll go even more so to correct its error than it would if it were doing it incrementally. In other words, most markets, you've seen it before, bubble tops in the stock market. When they fall apart, they really fall apart because they made a mistake by being too high priced for too long. Even if the underlying reality was true, like for instance, .com, the 2000 top in NASDAQ 100, all the claims made by the internet people were absolutely right. It would change your life for the better, okay? And yet NASDAQ 100 in 2 years dropped 82%, okay? Corrected an error. And it took it till 2016 to get back to its old high. So we have the opposite with silver. And also you can measure that, not just in its own compressed state for 50 years, but relative to gold, relative to any other asset. It's dirt cheap, and it said, hey, no, I don't belong down here. I'm going to have a temper tantrum. And, if you take the money factor, M2 growth, and you factor that into the old price size of silver and say, well, where should we be now given the money growth? You probably talk a couple $100 silver for sure. Okay. It's likely to overshoot whatever is a logical new reality because it's going to have a tantrum. And investors aren't aware of that.
Yeah. I guess it goes to show, markets aren't always rational like we would like to think that they are. People make mistakes, right?
Yeah. And you overcompensate sometimes. And that's what silver is going to do.
Yeah. And it's interesting, you talk about price manipulation. It's just like anything, right? When you fight against economics, eventually economics is going to win, right?
Yes.
And I think the Fed's in a similar position. They've been trying to manipulate interest rates for decades. And I think they're about to lose control of that game.
Yeah. Once it hurts the average guy, once, for example, I think oil's about to ambush everybody. Everybody's talking, oil's going to go to 40. There's so much oil. We don't need oil, et cetera. Our technical work says you get above 63 on oil. Right now, we're pushing 62. They're likely to blow your head off because we've got technical structures on momentum, not price. It won't alert the price guys. But you get above that 63 level during this quarter, especially on a monthly close. Our metrics say, don't be shocked by even a 50% surge in oil price, meaning the average guy pumping his gas. And Trump said, I'm going to keep it low, right? Okay. So far, he's smiling. It's the one thing he could smile about. Yeah. That could go away in a matter of a couple months with the technicals that I see.
Yeah.
And it won't even need an excuse. It's a pricing level.
Larry Kudlow was on his show the other day talking about how the dropping oil price was the greatest story never told, which incidentally is the same exact thing he said in December 2007 about the Bush economy. So,
well, anyway, the Fox guys are defending this. And of course, Trump is not the free market guy he said he was, who wants to intervene here, there, and everywhere, determine the prices of credit or credit cards, deny housing speculators from buying houses, so only residential people can buy them, all kinds of things that you would expect a socialist government to do. And he wants to print.
Yeah, that's the thing that I really kind of focused on, is just the incessant money printing.
Everything's upside down, in other words.
Yeah. Well, as you say, we're entering a new reality, and ultimate economics will win. And I'm really fascinated with your technical approach. I'm not a good technical analyst. I'm more interested, or not interested, but I'm more savvy with looking at macro factors and things like that. So I'm really fascinated with what you're doing. And I think it's an approach people should avail themselves of, because I think what you're talking about here, you're seeing things earlier based on what you're doing than some of the people that are just looking at price are getting. So what I would like for you to do is let folks know where they can follow your work and maybe dive into it more deeply if they're so inclined.
The website is Oliver MSA for Momentum Structural Analysis, olivermsa.com. We explain our unorthodox methodology. Again, we've been around since '92 doing it. And we've been very successful in timing major market turns, not just monetary metals, but stock market, bonds, et cetera. And request some sample copies. Simple as that.
Yeah. So folks, do that, because I think it'll expand and help you broaden your market analysis. Well, Michael, I know that you've got things to do today, and I want to get you out of here and be respectful of your time. But I really do appreciate you coming on and just giving us kind of a taste of the work that you're doing. Folks should go. Just Google Michael on the internet, and you'll find several really good interviews that are an hour plus that go much more deeply into it than we were able to in this short time we have here. So avail yourself of that info. Michael, thank you so much for coming on. And as we move forward, I would love to have you back on again in the future if you're so inclined.
Well, Michael, thank you very much for inviting me. Thank you.
Absolutely. Have a good afternoon.
Wonderful stuff there from Michael Oliver, and he really has called pretty much all of the recent price action in silver the last few months, so seems to be a man definitely worth listening to. Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. And to check out any of our audio programs, including our second podcast, the Money Metals Midweek Memo, just visit moneymetals.com/podcasts. Or find them wherever you listen to your favorite podcasts. And as a big help to us, we would ask that you please like, subscribe, download, and rate our podcasts. Doing so helps us extend the reach of this material. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.